Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me remotely, we have Chuck Mack, who's the head of U.S. Equities at Nasdaq, and we're going to take a look at spreads, liquidity, routing, Nasdaq's midpoint segment, MELO, during heightened volume and volatility. Chuck, it's great to have you with us on Trade Talks, and we certainly are in an unprecedented market of volatility. And so let's, get your thoughts on that, and then we can run through some of the specific things that you're seeing within the marketplace.
Sure. Thanks for having me, Jill. Like you said, there's very high level of volatility and volume in the market. We were at unprecedented levels throughout March. It's come off a little bit the last few days, but it's still quite elevated relative to what we're used to seeing in 2019, for example.
All right, and let's run through some of these metrics here. What about spreads?
Yeah, so anytime you're in a situation where the market has heightened volatility, what you generally see is an increase in demand for liquidity, especially in with more immediacy. People or investors are looking to move things more quickly, and so they're demanding more liquidity in a very immediate fashion. And just like any other market, when there's a shift in the demand curve or an increase in demand, you see the supply side change, usually resulting in higher prices if there's an increase in demand. And spreads is one way that you can measure the cost of liquidity in the market. And what we did see is what you'd expect. We saw spreads increase quite a bit across the board in both small caps and large caps. Interestingly, but not too surprisingly, we did see it increase more in small caps.
And have you seen any other interesting shifts in liquidity in the marketplace?
Yeah, it's really interesting. There's been a lot of talk about liquidity in the market, and in certain markets, there's been discussion about a challenge in finding a liquidity. But what's been really good in the U.S. equities market is, yes, spreads did widen, but there's always been liquidity available. It might not be at the price you particularly want it at, but there's always an opportunity to buy and sell, which I think speaks to just how well the markets have held up under high level of stress. What we've also seen, though, is some interesting trends in other areas within the market. So, for example, we've seen a lot more usage of non-displayed liquidity. In non-display, the easy way to think about that is, it's an order or a set of orders you would place on the exchange or in the market that just aren't advertised, and so people will execute them against them if they come into the order book, but they don't necessarily know they're there. And a common use case people talk about for these types of orders is maybe an institution has a big block of shares to move in a stock, and they want to be really thoughtful about what kind of information they're putting out in the market. And they may not want to advertise that by using displayed bids or offers, and so they'll put in a non-displayed order in the market. And so we've seen a lot more of that, since the volatility hit, more than I would have expected.
All right. Now, what about in terms of average price improvement?
Yeah. So, it's a good question. So, when you see the spreads increase, there's a lot more opportunity actually to use these non-displayed orders. And so if I'm an investor actually looking to lift an offer or hit a bid, I will end up interacting with these oftentimes better priced non-displayed orders. And so how that comes back to me is I see it as price improvement relative to the best bid and offer. And what's really interesting is we've seen, we've always had a good amount of price improvement on our book relative to the spread, but that's stayed pretty constant in percentage terms. But what's interesting is, if the spread, just to use an easy example, is normally 5 cents, and typically I get a penny better than what I'm seeing on the screen, we'll call that 20% price improvement over the spread. What we're seeing now is still 20% price improvement over the spread, but the spread might be 10 cents or 15 cents. So that notional price improvement is more like 2 or 3 pennies versus the one in the 5 cent example. So we're seeing quite a bit of that activity as well.
All right, and to wrap up here, let's spend a little bit of time with Nasdaq's special midpoint segment called MELO, and this is designed for investors with longer term horizons.
Yeah, so we talk a lot about MELO at Nasdaq. We're really happy with the product we put out there. Like you said, it's designed for investors with longer time horizons. There's a delay mechanism where people have to wait before they'll be eligible to execute with MELO, and it executes at the midpoint only, and it's really designed to limit market impact. And what you might expect to see when there's a lot of volatility like we've seen in the market is that the performance of this order type might degrade, and the way we measure the performance is, okay, when the order came in, what was the market? Okay, what was the market a second later? Did it move around a lot? And what we've historically found is 90% of the time the market doesn't move a second later, and so you might expect that to drop pretty significantly with this heightened level of volatility, but what we've seen is that's not really the case, and it remains just under 90% at around 88 or 89%. So it's really performed well, and we're looking to increase interaction opportunities for the users of MELO for the long term, the investors with the longer term horizon, by reducing the wait time for that, but still having it be pretty long given today's standards at 10 milliseconds. And we'll do a whole segment on that sometime in the future to get more into details.
All right, sounds great, Chuck. Thanks so much for joining us on Trade Talks.
Thanks so much, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.